Hello everyone and welcome back to the channel. Today we're diving deeper into the fascinating world of options with a focus on some key strategies: straddles, spreads, strangles, butterflies, and iron condors. We'll also explore a critical concept called put-call parity and how it shapes the pricing relationship between put and call options. Whether you're new to options or looking to expand your knowledge, this video is designed to help you understand these concepts clearly. So grab a notebook, get comfortable, and let's get started. First, let's set the stage. Options are financial contracts that give you the right but not the obligation to buy or sell an underlying asset like a stock at a specific price called the strike price, before or on an expiration date. Call options let you buy the asset while put options let you sell it. The price you pay for an option is called the premium. If you've watched our previous videos on call and put options, you're familiar with these basics. Today, we're building on that foundation to explore how you can combine options in different ways to create specific payoff profiles. And we'll dive into why puts and calls are priced the way they are due to put-call parity. Let's break it down step by step. We'll start with 5 common option strategies: straddles, spreads, strangles, butterflies, and iron condors. These strategies involve combining multiple options or sometimes options with the underlying asset to achieve different financial outcomes. Each has a unique purpose, depending on your expectations for the stock's price movement and volatility. We'll explain each one, focusing on how they work and what they're designed to achieve. First up is the long straddle. This strategy involves buying a call option and a put option with the same strike price and expiration date. Imagine you're looking at Tech Trend, a company trading at $100 per share. You expect a big price move in the next month, maybe due to an earnings report, but you're not sure if the stock will go up or down. You buy a call option and a put option, both with a strike price of $100, expiring in 1 month. Let's say the call premium is $4 per share and the put premium is $4 per share. Since each contract covers 100 shares, you pay $800 total, $400 for the call and $400 for the put. If Tech Trend's stock jumps to $120, the call option might be worth $20 per share, while the put expires worthless. If the stock drops to $80, the put option might be worth $20 per share, while the call expires worthless, yielding the same net difference. The long straddle is designed for situations where you expect a significant price swing, but aren't sure of the direction. The catch? You need a big move to offset the combined premiums, as both options could lose value if the stock stays flat. Next, let's look at spreads. A spread involves buying one option and selling another option of the same type, either both calls or both puts, with different strike prices or expiration dates. One common example is the bull call spread. You buy a call option with a lower strike price and sell a call option with a higher strike price, both with the same expiration date. For Tech Trend at $100, you might buy a call with a strike price of $100 for $4 per share and sell a call with a strike price of $110 for $1 per share. Your net cost is $3 per share, or $300 for 100 shares. If the stock rises to $115, the $100 call might be worth $15, while the $110 call is worth $5. Your gain is the difference, $10 per share, minus the $3 net premium for a $700 difference. The sold call limits your upside but reduces your cost, making spreads a way to balance potential gains with lower upfront costs. There are also bear put spreads, which work similarly but use puts to benefit from price declines. Now let's explore the long strangle. This is similar to a straddle but involves buying a call and a put with different strike prices, typically both out of the money and the same expiration date. For Tech Trend at $100, you might buy a call with a strike price of $110 for $2 per share and a put with a strike price of $90 for $2 per share, costing $400 total. If the stock surges to $120, the call might be worth $10 per share, while the put expires worthless, giving you a $600 difference after the $400 premium. If the stock drops to $80, the put might be worth $10, with the call expiring worthless, yielding the same net difference. Strangles are cheaper than straddles because out-of-the-money options have lower premiums, but they require a larger price move to become profitable. They're designed for scenarios where you expect a big price swing but want to keep costs down. Moving on to the butterfly spread. This strategy involves combining 4 options, either all calls or all puts, with 3 different strike prices. A long call butterfly might involve buying 1 call at a lower strike price, selling 2 calls at a middle strike price, and buying 1 call at a higher strike price, all with the same expiration date. For tech trend at $100, you might buy a call with a $95 strike for $5, sell 2 calls with a $100 strike for $3 each, and buy a call with a $105 strike for $1. Your net cost is the $5 and $1 premiums, minus the $6 from the 2 sold calls, or $0 net, though in practice, there's usually a small net cost. If the stock ends at $100 at expiration, the 2 sold calls expire worthless. The $95 call is worth $5, and the $105 call is worthless, giving you a potential gain. The butterfly is designed for situations where you expect the stock to stay near the middle strike price, offering a defined payoff with limited risk. Use platforms that let you construct multi-leg orders to place butterflies efficiently and see net debit credit up front. Butterflies typically perform best when implied volatility is moderate to low, and you expect limited price movement around the middle strike. Finally, the Iron Condor. This strategy combines a bull put spread and a bear call spread, selling out-of-the-money puts and calls while buying further out-of-the-money puts and calls to limit risk. For tech trend at $100, you might sell a put with a $90 strike for $1, buy a put with an $85 strike for 50 cents, sell a call with a $110 strike for $1, and buy a call with a $115 strike for 50 cents. Your net premium received is $1 per share, or $100 for 100 shares. If the stock stays between $90 and $110 at expiration, all options expire worthless, and you keep the $100 premium. The Iron Condor is designed for situations where you expect the stock to stay within a range, offering a way to benefit from low volatility with defined risk. You can adjust Iron Condors by rolling strikes or closing legs early to manage risk if the stock approaches a short strike. Now let's dive into put-call parity, a fundamental concept that explains why put and call options are priced the way they are. Put-call parity is a mathematical relationship that links the prices of a call option, a put option, the underlying stock, and a risk-free bond. It ensures that you can recreate the payoff of a call option using a put option and the stock, or vice versa, preventing arbitrage opportunities where someone could profit without risk. The basic formula for put-call parity is the price of a call option plus the present value of the strike price equals the price of a put option plus the current stock price. In simpler terms, for options with the same strike price and expiration date, the call premium plus the cash needed to buy the stock at the strike price should equal the put premium plus the stock's current value. Let's illustrate with tech trend at $100. Suppose a call option with a $100 strike expiring in 1 year costs $5 per share, and a risk-free bond paying the strike price in 1 year is worth $95 today, assuming a discount for interest rates. Put-call parity says the corresponding put options price plus the stock price, $100, should equal the call price, $5, plus the bond value, $95. So the put price should be $5. If the put were priced at $4, you could buy the put, buy the stock, sell the call, and invest the proceeds in the bond, creating a risk-free profit. An arbitrage opportunity the market corrects by aligning prices. Why does this matter? Put-call parity shows that puts and calls are interconnected. You can replicate a call's payoff by buying a put, buying the stock, and borrowing the present value of the strike price. Similarly, you can replicate a put's payoff by buying a call, shorting the stock, and lending the strike price's present value. This flexibility means many payoff profiles, like those in straddles or spreads, can be created using different combinations of options and the underlying stock. However, because of put-call parity, the premiums of puts and calls are tied together. If a call is expensive due to high implied volatility, the corresponding put will also be pricey, adjusted for the stock price and interest rates. This relationship ensures consistent pricing across strategies as the market balances the costs of equivalent payoffs. At this point, we're about 2/3 through the video, and I hope you're finding this informative. If you're enjoying the content, please take a quick second to hit that like button. It really helps the channel grow. And if you want more educational videos like this, don't forget to subscribe and click the notification bell so you never miss an update. Thanks for your support. Let's talk about some key concepts to understand when learning about option strategies. First, know the underlying asset, whether it's a stock or an index. Understanding what drives its price movements, such as company performance or market trends, helps explain why these strategies work the way they do. Second, grasp the role of volatility. As we discussed in previous videos, implied volatility reflects the market's expectation of future price swings, while realized volatility measures past price movements. Strategies like Straddles and Strangles rely on high implied volatility as they benefit from large price moves, while butterflies and iron condors thrive in low volatility environments where prices stay stable. Third, understand risk profiles. Each strategy has a defined maximum loss and potential gain. For example, a long straddle's loss is limited to the premiums paid, but its potential gain is theoretically unlimited if the stock moves significantly. Iron condors, by contrast, have both limited gains and losses, making them suited for range-bound markets. Fourth, consider the Greeks. Metrics like delta, how an option's price changes with the stock price, and theta, time decay, are crucial for understanding how these strategies behave over time. Platforms often display these for educational purposes. Finally, explore strategies through educational tools. Paper trading accounts let you simulate these strategies without real money, helping you see how straddles, spreads, or iron condors perform in different market conditions. Now, let's cover some common pitfalls to understand when studying option strategies. One major one is ignoring the impact of time decay. Strategies like Straddles and Strangles involve buying options, which lose value as expiration nears, so you need a significant price move to offset this. Another pitfall is overlooking the bid-ask spread, the difference between what buyers pay and sellers ask. Wide spreads can increase costs, especially in complex strategies like butterflies or iron condors with multiple options. Also, avoid assuming strategies work in all markets. A straddle thrives on big price moves, but if the stock stays flat, you lose the premiums. Conversely, an iron condor needs a stable stock price, and a big move can lead to losses. Understanding market conditions is key to grasping these strategies. Phew, we've covered a lot today. Before we go, I'd love to hear from you. In the comments below, tell me, which option, strategy, or concept, like put-call parity, did you find most interesting? Or what other financial topics would you like me to cover in future videos? Your feedback helps shape the channel, so drop your thoughts below. Thanks for watching, and if you found this video helpful, please give it a thumbs up and subscribe for more educational content on finance and markets. Until next time, stay curious and keep learning.